Did you know that over 80% of investors make decisions based on emotions rather than logic, leading to significant financial losses? Have you ever panicked during a market drop or chased a hot stock out of fear of missing out? Stick around to learn how to avoid these emotional traps and take control of your investments. Welcome to the channel. I'm your name, and today we're diving into one of the biggest challenges every investor faces: managing emotions. Investing isn't just about numbers, it's about psychology. Fear, greed, and even overconfidence can wreak havoc on your financial portfolio. In this video, we'll explore 5 emotional traps that sabotage investments, how to recognize these pitfalls, and most importantly, how to overcome them. If you've ever felt your emotions clouding your investment decisions, this is the video for you. Let's get started. Let's talk about why emotions can be such a problem for investors. One of the most common traps is fear. When markets drop, it's natural to feel anxious, but fear can lead to panic selling, locking in losses that could have been avoided if you'd stayed the course. On the other side of the spectrum is greed. This is when you chase investments based on hype or unrealistic expectations. Greed often leads to buying at market peaks, only to watch the value plummet. Another emotional challenge is regret. Investors often dwell on past mistakes, such as selling too early or missing out on a big opportunity. This regret can paralyze decision-making or push you into rash choices. There's also overconfidence, where you believe you can outsmart the market. This can lead to risky bets or ignoring signs that your strategy isn't working. Finally, there's impatience. Long-term investing requires discipline, but impatience can cause you to jump in and out of positions, missing out on potential gains or racking up unnecessary fees. These emotions are completely natural, but when they drive your investment decisions, they can create chaos. Let's dig deeper into the psychology behind these emotional traps and how they influence investor behavior. One major bias is loss aversion. Studies show that people feel the pain of a loss twice as strongly as the joy of an equivalent gain. This often causes investors to hold on to losing stocks for too long, hoping they'll recover, or to sell winning stocks too quickly out of fear of losing profits. Another common bias is herd mentality. When everyone else is buying a hot stock, it's easy to feel the pressure to follow along. But chasing trends can lead to overpaying for assets that are already overvalued. Overconfidence is another trap. For example, an investor might believe that their research or intuition is foolproof, leading them to take excessive risks. Overconfidence often leads to underestimating the importance of diversification or ignoring red flags. Confirmation bias is when you only seek out information that supports your existing beliefs. If you're convinced a stock will go up, you might ignore data that suggests otherwise, leading to poor decisions. Finally, there's recency bias, where investors place too much emphasis on recent events, such as a sudden market drop or a rally, and let those events dictate their strategy. This short-term thinking often clouds long-term goals. So how can you overcome these emotional traps? The key is having a clear, rational plan and sticking to it no matter what the market is doing. Start by creating a written investment plan. Outline your financial goals, risk tolerance, and time horizon. This plan acts as your guide, helping you stay focused even during volatile times. Another strategy is to adopt automated investing. Tools like dollar-cost averaging help you invest consistently, removing the temptation to time the market based on emotions. It's also important to diversify your portfolio. By spreading your investments across different asset classes, you reduce the impact of any single market movement. Finally, take a moment to reflect before making any investment decision. Ask yourself, am I acting out of fear or greed? Is this decision aligned with my long-term goals? Practicing mindfulness can make a huge difference in avoiding rash choices. These strategies help you stay disciplined and prevent emotions from taking over your investment strategy. To summarize, emotional traps like fear, greed, overconfidence, and impatience can sabotage your investments. By understanding psychological biases like loss aversion and herd mentality, you can recognize these traps before they derail your strategy. The solution lies in having a clear investment plan, automating your contributions, diversifying your portfolio, and taking a step back before making emotional decisions. Investing is a long-term game, and staying rational is the key to success. Now, I want to hear from you. Have you ever fallen into one of these emotional traps? Share your experiences in the comments below. Don't forget to like this video, subscribe to the channel, and watch our next video on building a resilient investment strategy. Thanks for watching, and happy investing!